Did you know that 75% of the world's wealth is tied to business ownership? It's true, being a business owner, not just an employee, is one of the fastest ways to build long-lasting wealth. But here's the kicker. Most people have no idea how the rich actually buy businesses. It's not about having millions in the bank or a golden ticket. It's about smart strategies and taking calculated risks. In this video, we're going to reveal the secrets the wealthy use to buy businesses that make them rich. From finding hidden opportunities to negotiating deals like a pro, you'll discover the strategies that almost no one talks about. You'll learn how to see business potential where others see problems, and how the rich fund their purchases without using their own money. Ready to unlock the best way to buy a business? Stay tuned. This is just the beginning of a journey that could change the way you think about wealth forever. Chapter 1. The Rich Mindset. Unlocking the business buying blueprint. When you think about buying a business, the first thing that comes to mind might be money. But the reality is that the rich think differently. They don't just see a business for its price tag, they see it for its potential. Billionaire investor Warren Buffett once said, "Price is what you pay. Value is what you get." Understanding this simple truth is the first step in adopting a rich person's mindset when it comes to buying a business. The wealthy view business acquisitions as a way to grow wealth, not simply as a one-time transaction. It's about creating an ongoing stream of income. Research by the Kauffman Foundation shows that nearly 75% of new job creation comes from businesses that are 5 years or older. That's a hint that older businesses often hold hidden value. The rich also know the power of leverage. When they buy a business, they don't always dip into their savings. Instead, they use other people's money or their own assets to secure financing. For example, 45% of all mergers and acquisitions in the US are financed through debt, according to Harvard Business Review. This allows them to minimize risk and maximize returns. They also take a long-term view. The rich often see business acquisitions as a way to build a legacy. As entrepreneur Richard Branson puts it, business is about making an impact, not just making money. And that's the kind of mindset that allows the wealthy to acquire, scale, and hold on to businesses that create generational wealth. Another key trait of the wealthy mindset is patience. They don't rush to make a deal. A study by the Corporate Finance Institute found that successful acquisitions often take months to plan, with research being the backbone of the process. The rich understand that the best deals don't happen overnight. It's about finding the right business at the right price and ensuring it aligns with their goals. In conclusion, to think like the rich when buying a business, it's crucial to adopt a strategic mindset. You need to see value where others see cost, use leverage to your advantage, and be patient in waiting for the right opportunity to strike. Chapter 2. Hidden Gold Mines. Finding businesses that make millionaires. The key to becoming wealthy isn't necessarily buying big, well-known businesses. It's about finding the hidden gold mines. Research shows that 75% of wealth is made through strategic investments, and that includes buying small businesses. The rich understand that these hidden gems can offer massive returns. One of the best ways to find businesses with untapped potential is by tapping into networks. The rich often turn to personal connections, industry insiders, or even family members when searching for businesses to buy. In fact, 40% of all successful deals happen off-market, according to a study by the M&A Source. This is where having a strong network pays off. Another strategy is to look for distressed businesses. A business that is struggling may be undervalued and in need of new leadership. As Jeff Bezos famously said, "If you're not willing to take risk, you can't grow." Buying distressed businesses can come with risks, but it also opens the door to incredible rewards. You can often purchase these companies at a fraction of their value and turn them around with smart leadership and vision. Additionally, finding niche markets is a great way to uncover hidden opportunities. The wealthy often invest in businesses that serve specialized customer bases, which are less likely to be targeted by large competitors. For example, small boutique consulting firms or unique service providers can often be more profitable than they initially appear. Private equity firms also have a secret weapon: data. By using sophisticated software and analytics, They can track down businesses that are underperforming and identify which ones have the most growth potential. In fact, 56% of successful business acquisitions are the result of data-driven insights, according to Bain & Company. Finally, consider looking at businesses in industries that are emerging or evolving. The wealthy often invest in businesses that are early to new trends. For instance, the rise of electric cars and renewable energy has seen the wealthy invest in businesses within these sectors before they became mainstream. In essence, the rich know that finding the right business to buy is about looking beyond the obvious. It's about leveraging networks, using data, and having the patience to find businesses with long-term growth potential. Chapter 3. Business Mastery. How the rich analyze deals like a pro. When it comes to analyzing a business acquisition, the wealthy take a much more calculated approach than the average buyer. They don't just rely on gut feelings or surface-level numbers. They dive deep into the financials, operations, and future potential of the business. In fact, 68% of investors say their first step is to conduct detailed due diligence before even considering a deal, according to a report by PitchBook. The rich know that financials tell only part of the story. For example, while an income statement might show strong revenues, it doesn't always reveal the underlying operational issues. To get a complete picture, the wealthy examine cash flow, liabilities, and even customer retention rates. This is crucial because cash flow is often a better predictor of a business's future success than profits alone. Another strategy the rich use is identifying areas where a business is undervalued. They know how to spot inefficiencies and weaknesses in a business model that can be fixed. This could be anything from reducing operating costs to improving customer acquisition strategies. According to Forbes, many of the most successful business owners have made their wealth by buying businesses, improving them, and then selling for a higher price. The wealthy are also strategic about timing. They know that buying a business at the right time can make all the difference. That's why many wealthy buyers prefer industries with predictable cash flows or businesses with proven track records. For example, industries like healthcare, technology, and real estate have long been favorites for savvy investors. A unique tactic often used by the rich is hiring experts to help them with analysis. They don't rely on just their own knowledge. They bring in accountants, consultants, and industry specialists to give them a full assessment. This is especially important when buying complex or highly technical businesses. A study by Deloitte found that 44% of business buyers hired a team of experts to conduct a thorough due diligence process. The wealthy are also strategic about identifying the human capital within the business. They understand that the quality of the employees and the leadership team can make or break a company. That's why many wealthy buyers will take the time to meet with key personnel and assess their potential to grow the business. Finally, the rich look beyond just financials and operations. They consider the future. What are the long-term trends in the industry? How will technology impact this business in the next 5 to 10 years? Being able to predict future market shifts is a key trait of successful business owners. In conclusion, the way the rich analyze business deals is a combination of financial expertise, strategic thinking, and foresight. By diving deeper into the numbers, timing their investments correctly, and always thinking ahead, the wealthy are able to make smarter, more profitable acquisitions. If you want to dive deeper into how to make smarter investments and acquire businesses, make sure to hit that subscribe button. Stay tuned for more strategies in the next chapters. Chapter 4. The Art of the Deal. Negotiation secrets of the super wealthy. When it comes to buying a business, the negotiation process is often where the real magic happens. The rich understand that negotiation is not just about haggling over price, it's about creating value for both sides. Legendary investor Carl Icahn once said, "The most important thing in life is not to be afraid of being human." That means negotiations should focus on building relationships, not just securing the best deal for yourself. A key strategy used by the wealthy is to negotiate with the long-term vision in mind. They know that offering fair terms can create a foundation for future partnerships and business growth. Research by McKinsey & Company shows that nearly 60% of successful business deals come from creating strong post-deal relationships. The rich are also known for their ability to remain calm and patient during negotiations. While the average person might rush to close a deal, the wealthy wait for the best terms. A study from Harvard Law School's program on negotiation shows that taking your time in negotiations leads to more successful outcomes and better financial terms. One tactic they often use is anchoring. By starting with an offer that's slightly below their desired price, they can guide the negotiations toward a more favorable outcome. For example, in a deal where the asking price is $10 million, the wealthy might offer $7 million. This sets the stage for future negotiations to settle somewhere closer to their target price. Another secret of the rich is knowing when to walk away. Billionaire investor Mark Cuban says, "The best deals are the ones you don't do." By being willing to walk away from a bad deal, they avoid overpaying and leaving money on the table. Studies show that negotiation outcomes improve when buyers have the freedom to walk away, as it removes the pressure of desperation. The wealthy also know how to get creative with deal structures. Rather than just buying a business outright, they often propose earn-outs, stock options, or joint ventures. A report from Deloitte found that 37% of M&A deals use earn-outs to structure payments based on future performance, allowing buyers to reduce risk while providing sellers with potential upside. A critical part of the negotiation process is controlling emotions. The wealthy know that making decisions based on emotions can lead to bad choices. According to research by the University of California, emotionally driven decisions in business negotiations often result in losing significant value. Lastly, the wealthy are always prepared. They come to the table with deep knowledge of the business and the market. They know the value of the company they are negotiating for, which gives them confidence to ask for better terms. In fact, data from the Harvard Business Review shows that well-prepared negotiators are 40% more likely to achieve favorable terms. In summary, the rich master negotiations by remaining calm, being patient, and thinking long-term. They use tactics like anchoring, walking away, and deal structuring to secure the best possible terms while maintaining good relationships with sellers. If you enjoyed learning about negotiation strategies and want more insider tips, be sure to subscribe and turn on notifications. Don't miss out on the next chapter. Chapter 5. Leveraging Wealth. Funding your business acquisition with zero of your own money. One of the most powerful tools in the arsenal of the wealthy is leveraging other people's money, OPM, to fund business acquisitions. This strategy allows them to expand their portfolios without putting up significant amounts of their own cash. According to Forbes, more than 50% of business acquisitions are financed with OPM, which enables the wealthy to scale quickly while minimizing their financial risk. The first step in leveraging wealth is using debt financing. When purchasing a business, the wealthy often use loans or other forms of debt to fund the deal. The idea is simple. Take out a loan at a lower interest rate than the return the business can generate. A study by the National Bureau of Economic Research found that businesses financed with debt tend to grow faster than those funded purely by equity. Another creative financing tool the wealthy use is seller financing. This is where the seller agrees to finance part of the purchase price, allowing the buyer to pay the seller over time. According to the International Business Brokers Association, seller financing accounts for 20% of all small business transactions, giving buyers more flexibility and reducing their upfront costs. Private equity firms also play a role in how the wealthy fund their business acquisitions. By pooling funds from multiple investors, private equity firms can acquire larger businesses without using their own capital. According to PitchBook, private equity firms account for nearly 30% of all M&A activity in the United States, making it a powerful method for acquiring businesses. The rich also use creative funding strategies like equity partnerships. In this arrangement, they bring in other investors to co-own the business. The wealthy typically contribute their expertise and management skills while others provide the capital. This allows both parties to share the risks and rewards. A report by EY found that 40% of successful business acquisitions involve joint ventures or partnerships. Leverage can also come from real estate. Often, the wealthy will use the equity in their real estate holdings as collateral to finance business acquisitions. By borrowing against properties they already own, they can secure loans with favorable terms. This strategy is common among real estate moguls and business owners alike. The key to using other people's money effectively is to minimize risk. The wealthy understand that high-risk ventures can lead to substantial losses. That's why they structure deals in a way that ensures they won't be on the hook if the business underperforms. One way to do this is by securing guarantees, such as collateral or performance-based payments. In conclusion, leveraging OPM is a cornerstone of how the rich acquire businesses. By using debt, seller financing, private equity, and partnerships, the wealthy can expand their portfolios without risking their own capital. The ability to leverage assets and resources is what allows them to build vast empires. Chapter 6. From Buyer to Leader. Transforming a new acquisition into a legacy. The process of buying a business is only half the battle. The real challenge comes when it's time to lead and transform that business into a lasting legacy. The rich understand that business ownership isn't just about making money, it's about creating something that can stand the test of time. In fact, 85% of family-owned businesses fail to transition to the next generation, according to a study by the Family Business Alliance, but the wealthy know how to avoid this pitfall. The first step in this transformation is leadership. Successful business owners know that their role is to inspire, not just to manage. Warren Buffett says, "The best thing I did was to choose the right people." By hiring talented leaders and empowering them to drive the business forward, the rich ensure that their businesses grow and adapt. They also focus on culture. A strong, positive company culture can drive employee satisfaction and productivity. Research by Gallup found that businesses with engaged employees outperform their competitors by 147% in earnings per share. The wealthy understand that a positive work environment leads to long-term success. Innovation is another key to transforming a business. The rich constantly look for ways to improve products, services, and processes. They're not afraid to disrupt their own businesses. As Steve Jobs famously said, innovation distinguishes between a leader and a follower. By staying ahead of trends and encouraging creative solutions, the wealthy turn their acquisitions into industry leaders. Scalability is also critical. Once the business is stable, the wealthy focus on growth. Whether it's expanding into new markets, launching new products, or acquiring complementary businesses, they constantly look for ways to scale. According to the Harvard Business Review, businesses that successfully scale are 50% more likely to survive long-term. A major part of building a lasting legacy is sustainability. The wealthy know that for a business to thrive in the long run, it must be adaptable to change. They often invest in technology and infrastructure that allows the business to evolve with the times. In fact, 72% of successful businesses use technology to help them scale, according to a study by McKinsey. In conclusion, the rich transform their business acquisitions into lasting legacies through strong leadership, a focus on culture, innovation, and scalability. By building a foundation for long-term success, they ensure that their businesses grow and prosper for generations to come. Don't forget to subscribe and hit the notification bell so you can stay ahead in the world of business. We'll see you in the next chapter with even more insights.